In the late summer of 1929, as Wall Street celebrated what appeared to be an endless boom, Joseph P. Kennedy was quietly doing the opposite of everyone around him. While stock tickers flashed record highs and newspapers declared a new era of permanent prosperity, Kennedy was selling. Not trimming a little risk or hedging cautiously, but systematically exiting the market that had made him rich. Within weeks, the greatest financial collapse in American history would begin, and Kennedy would stand among the few who walked away intact. The 1929 crash is often remembered as a sudden catastrophe, an unforeseeable rupture in an otherwise healthy system. That version of history is comforting because, it suggests no one could have known what was coming. But Kennedy's actions tell a far more unsettling story. His timing raises a question that still haunts financial markets today. Was the crash truly unpredictable, or did those closest to power see it forming long before the public felt the impact? Joseph Kennedy was not a passive investor swept along by market optimism. He was an insider's insider, a man who understood how markets were built, manipulated, and ultimately undone. His fortune was not born from blind faith in growth, but from recognizing when speculation detached from reality. By the time ordinary Americans were borrowing to buy stocks on margin, Kennedy had already begun preparing for the moment when confidence would collapse. What made Kennedy different was not access to a single secret tip, but his position inside the machinery of finance itself. He moved easily between Wall Street trading rooms, political circles, and corporate boardrooms, absorbing information long before it reached newspapers or regulators. He watched leverage pile up, standards erode, and speculation replace investment. To Kennedy, the market no longer resembled opportunity, it resembled danger. When the crash finally came in October, it erased fortunes, destroyed banks, and shattered faith in the American economic system. Millions would lose jobs, homes, and savings, while an entire generation would be marked by financial trauma. Yet Kennedy emerged not only preserved, but positioned for greater influence in the years that followed. His survival was not accidental, it was strategic. This story matters now because the mechanisms that defined 1929 did not disappear with the wreckage. They were rebranded, regulated, and rebuilt into modern systems that still reward those closest to information and punish those last to react. To understand how Joseph Kennedy preserved his wealth is to confront an uncomfortable truth about markets, power, and who is allowed to escape when the system breaks. Joseph Kennedy's instincts were shaped long before the euphoria of the late 1920s. Born into a politically connected Irish-American family, he learned early that wealth and power were inseparable from timing and access. By his early 30s, Kennedy had already built fortunes in banking, shipbuilding, Hollywood studios, and stock trading. Unlike many of his contemporaries, he did not view finance as a gamble, but as a system governed by human behavior, incentives, and leverage. Wall Street in the 1920s was a place of unprecedented speculation. Stocks could be purchased with as little as 10% down, borrowed money flowed freely, and brokers aggressively encouraged ordinary Americans to participate. Corporate profits mattered less than momentum, and rising prices became proof of value in themselves. This was not an accident, but the result of a loosely regulated system that rewarded volume, risk, and short-term gains. Kennedy thrived inside this environment precisely because he understood its weaknesses. As a trader and pool operator, he participated in practices that were legal at the time but deeply destabilizing. Large investors coordinated trades to drive prices upward, creating the illusion of demand and drawing in the public at inflated levels. Kennedy saw firsthand how easily markets could be moved, and how quickly confidence could vanish once the illusion broke. By 1928, warning signs were everywhere for those willing to look. Corporate debt was rising faster than earnings, margin loans reached record levels, and price-to-earnings ratios stretched far beyond historical norms. The Federal Reserve attempted modest tightening, but speculation continued unabated. To Kennedy, this imbalance signaled not opportunity, but fragility, a structure that could not withstand even a minor shock. Crucially, Kennedy's network extended far beyond the trading floor. He maintained relationships with bankers, politicians, and industrial leaders who privately expressed concern even as they publicly celebrated prosperity. He understood that markets do not collapse when fear is universal, but when confidence among insiders begins to fracture. By the time public enthusiasm peaked, elite caution had already set in. In early 1929, Kennedy began reducing exposure across sectors, converting paper wealth into cash and hard assets. He did so quietly, avoiding the kind of public signals that might trigger panic or scrutiny. While newspapers praised record-breaking rallies, Kennedy was executing an exit shaped by experience, information, and a deep understanding of how financial manias end. The strategy that protected Joseph Kennedy was not a single dramatic sale, but a disciplined understanding of how financial systems fail. Markets collapse not because prices are high, but because leverage becomes unsustainable and trust evaporates. In 1929, margin debt magnified every small decline, forcing investors to sell into falling prices. Kennedy recognized that once selling began, the structure of debt would turn a correction into a catastrophe. When stocks began to slide in October, the mechanism Kennedy had anticipated unfolded with brutal speed. Brokers issued margin calls that investors could not meet, triggering forced liquidations across the market. Prices fell, not because everyone suddenly agreed stocks were overvalued, but because the system demanded cash that did not exist. What had been marketed as easy wealth became an inescapable trap. Kennedy's advantage was timing reinforced by liquidity. By holding cash when others were fully leveraged, he was not exposed to forced selling. While portfolios around him collapsed, his capital remained mobile and intact. Liquidity in moments of crisis is power, and Kennedy had positioned himself to possess it when it was most scarce. The consequences of the crash were devastating and unevenly distributed. Banks failed by the thousands, wiping out deposits and freezing credit across the country. Industrial production collapsed, unemployment surged, and global trade contracted sharply. Yet for those with preserved capital, the aftermath also presented opportunity, as assets could be acquired at fractions of their former value. Kennedy understood this asymmetry well. The sea or ash did not eliminate wealth, it transferred it. Those who entered the downturn fully invested bore the losses, while those who exited early were positioned to shape the recovery. Kennedy's wealth and influence expanded in the 1930s, culminating in his appointment as the first chairman of the Securities and Exchange Commission, a role that symbolized both reform and irony. His rise after the crash revealed a deeper truth about financial crises. The same individuals who understand the system well enough to profit from it are often best equipped to survive its failures. Kennedy's experience demonstrates that crashes are not merely economic events, but redistributions governed by access, preparation, and structural advantage. Joseph Kennedy's legacy is often framed as foresight, intelligence, or even luck, but those explanations stop short of the deeper reality. His survival of the 1929 crash was the product of structural position, not prophecy. Kennedy stood close enough to the centers of power to sense when confidence was artificial and when risk was being quietly offloaded. He did not predict the crash's date. He recognized the system's breaking point. The uncomfortable truth is that markets are not neutral arenas where everyone receives the same signals at the same time. Information moves through hierarchies, not headlines. By the time panic reaches the public, decisions have already been made in private offices and closed networks. Kennedy's advantage lay in understanding that the most dangerous moment in any boom is when optimism is loudest and caution has gone silent. After the crash, Kennedy's influence only deepened. As chairman of the Securities and Exchange Commission, he was tasked with regulating the very practices he once used to build his fortune. This dual role revealed the paradox of American finance. Reform is often led by those who know how the system can be bent, not broken. Kennedy helped impose order on markets that had destroyed millions, while his own wealth remained largely untouched. What the Kennedy story ultimately exposes is not a single man's brilliance, but a recurring pattern in economic history. Crises do not erase power. They concentrate it. Each collapse redraws the map of ownership, transferring assets from the many to the few who prepared. The rules may change, but the hierarchy remains remarkably stable. Nearly a century later, the mechanisms that defined 1929 still exist, embedded in modern financial systems with new instruments and greater speed. Leverage, speculation, and insider advantage have not vanished. They have evolved. The names on the buildings may be different, but the structure that rewards early exits and punishes late believers endures. Joseph Kennedy preserved his wealth by understanding a impulsive, unsettling truth. The market does not fail everyone equally. When the system breaks, it reveals who was protected all along. That lesson, more than the crash itself, is the enduring power behind the Kennedy story.